Hey everybody, have you been worried about where the market is going? And are you wondering if we're crashing? Maybe you're wondering when the big crash is going to happen. What if I told you it's already happening? That's what we're going to talk about in this video. Let's go. Hey everybody, it's Jeremy Whaley here from Trade Maestro, and I want to address some issues that I've been seeing on Telegram and various social media outlets, specifically as it relates to the market and market crashes and what's going on. I mean, we're seeing markets that are up 900 and 1,000 points one day, they're down 1,000 points the next day, and some people keep saying, when's the crash going to happen? So I wanted to address that in this video, and I want to just kind of go back, do a little bit of history. I want to show you where we've been, where we're going, what I'm anticipating for the future, and just kind of give you an idea of where we are. So I'm going to go over here and start sharing some charts with you. You should be seeing my charts at this point. And what you're looking at on this screen, for those of you who maybe are not as aware of how charts look and work, this is the Dow Jones Industrial Average as charted out in a charting software called TradingView. So you're looking at all the price history of the Dow Jones. What I'm going to do now for a brief moment is turn off all these lines. These lines are something that we use to help identify prices. But what you see, let's just kind of do a high-level overview to get started here. Since the beginning of the year, the Dow Jones started off around 37,000, and we're currently trading around 32,000. So it's about a 5,000 point drop in the Dow. Now, a lot of you look at that and you might think to yourself, that's not really that big of a drop. And you would be correct. If you look at this from the perspective of the big picture, it's not really that big of a drop. In fact, it's not much of a drop at all. It does represent about 15%. But in the scope of things, it's not really that big of a move. And so for some of you, this is maybe good news. It might lead you into a certain complacency because you feel like it's not really that bad. For others of you, ironically, this has been a little bit frustrating because some of you are really expecting to see a market crash and you're wanting to see it crash. Well, I have news for you. We've already been crashing and we're going to continue crashing. You just don't necessarily know how to see it yet. I want to show you a couple of other charts really fast. This one that you're looking at right now is the NASDAQ, and that one looks a little bit more intense. Now, if you listen to the mainstream media, the media is not telling you the full story. This picture of the NASDAQ, you can see back in November, we were trading up here around about 16,000, just a little bit more than 16,000. And as of today, we closed down at 11,737. Whoa. That's also a 5,000 point move. But if you look at 5,000 points on a 16,000 point scale versus 5,000 points on a 36,000 point index, this represents almost 30%. This is a much, much bigger move, and it's been taking place since November. Now, the problem with the news media is what? The news media only talks about from January 1st. So they look at this and they say, well, since the first of the year, we're down 4,000 or 5,000 points. And until the last week, they really hadn't made such a big deal about it. Now I think people are starting to figure out that there's some bad stuff that's going on. And in fact, we are in the middle of a market correction, not just a correction, but a major market downturn. And we've been in this market since November. There's another index I want to show you. That's the Russell 2000. This is known typically as the, let me get it pulled up here. This is known typically as a small index. Small cap index is what I meant to say, not small index, but the small cap index. And you notice that the Russell 2000 was at 2,400 back in November. And here we are today at 1761. So let me just do some quick math with you here. We're going to do some of this. And for those of you who have not run these numbers, this might be a little boring. For the rest of you, you can be like, oh, that's interesting. So big round numbers here, 2,400. We're currently at 1760. And if you look at that, the difference is 640. Divide that by 2,400 point index. Folks, the Russell is down 26.6666666%. So that's where we are since November, 26.666%. Okay. So 25%, 26%, almost 30%. What do you guys think? Are we in a market correction? Well, based on different people's opinions, yes. Based on some people's opinions, no. So mainstream media has historically considered anything more than a 10% correction a recession or a downturn. For those of us that do active market analysis, we really don't look at those numbers. In fact, by the time we've corrected 10%, most of the time, the market just picks up and continues in a bullish direction. What I'm more concerned about are market reversals, and that's what you can see in the historical performance of the chart. I want to go back to the Dow Jones Industrial Average for a little bit, and we're just going to take a little trip through history, a little trip through time, if you will. And I want to show you what's happening right now and where we have been in the past and what I believe is happening. So I'm going to zoom out. I'm going to rescale this, and one of the things I don't love about TradingView is the scaling is not always easy. So I might have to rescale a few times here. Forgive me for that. But I'm going to scoot this thing back in time. Just imagine you're jumping in a time machine and we're warping all the way through history to the year 2007. Year 2007, folks, was the last time that we had a big market correction that looked exactly like we're in right now. This is what it ended up looking like in history. Okay, now, the reason I come back to 2007 is because, number one, this is the last major market reversal that we had. 2007 was the market top, and then the bear market took place mostly through 2008 and into 2009. You guys effectively know this as the 2008 financial crisis. There was a lot more going on. People just don't realize what was going on at the time. So I'm going to show you what was really happening. First of all, the financial crisis did not start in July and August of 2008, which is when they gave credit to it. The financial crisis began in 2007 when the market peaked in October of 2007. Now, I just drew a little circle in here, and what you're going to notice is the next circle I draw is the peak before, and then you're going to notice the peak that I draw after. This creates a chart pattern that we know as a head and shoulders formation. If you look at this, you draw one move to the first circle, back down, up to the middle circle, back down to the next circle. And we call this a shoulder on the left. This is like a little head, and this is like a little right shoulder. Now, that looks like absolutely no human that you or I have ever looked at, but in the world of technical analysis, we call that a head and shoulders. This is a market top. It's a substantial market top. Whenever we see a head and shoulders formation, not every time, but more often than not, it does lead to a full-blown market reversal. It can happen on an individual stock. It can happen on an index, which is a metric for the overall market. And we saw this take place in the peak in October 2007. Now, what's confusing about market tops is market tops are not preceded by a sentiment of bearishness. Market tops are preceded with a sentiment that the market is going to continue going higher. So to understand the psychology of what's happening in the mind of the trader at this point, you have to go back a little further in time and understand how we got here. So let's just put October 2007 on the right side of the chart, and then we're going to zoom out a little bit and notice how we got here. We had been through the 2000 market crash. We'd been through 9/11. We went through all that chaos. We bottomed in 2003. And at that time, the Dow Jones was around 7,200. And for this time period between 2003 and 2007, which was a 4-year period, the market had basically doubled. Now, if you look at this and you go in a 4-year cycle, you realize that most people by October of 2007 are not thinking the market's about to go down. After all, why would we? The bear market of 2001 and 2002 and 2003 is long gone. The dot-com bust is long gone. The euphoria of market traders at this point is very, very high. That's all people believe will continue. So what do we see at market tops? We see market euphoria. And as soon as I said that, I realized I don't think I have a clue how to spell euphoria, but that might be how you spell euphoria. It's excitement. It's how people feel about the market at that time. Whenever people are very euphoric, what do? They keep buying, they keep buying. And more importantly, they buy the dips. In fact, this is a piece of old investing wisdom that's pretty not good, but it's a very common investment advice is when the market pulls back, you buy the dips. So as the market pulled back into November of 2007, at this point, nobody knew that the market was about to crash. Instead, as we pulled back to around 12,800 in the Dow, people started buying again and they started to rally. But very soon, that rally gave way and we had what is called a false top or a false rally. It could not make a higher high. And you notice that this head and shoulders started to get established with a lower high. Okay, so before that, we had rallied with a higher high and a higher low. Previous low was lower, previous high was lower. So we continue making higher highs and higher lows. The top of the head is a higher high. Nobody at this point is thinking market correction. Okay? Then you have a matching low. Nobody's thinking market correction. But as soon as, and I'll change our pen color just so you can see exactly what I'm drawing to, as soon as we put in a lower high, that's the first signal that every trader should be paying attention to. And you say, uh-oh, why did we just put in a lower high? Now, once you put in that lower high, everybody's eyes have to start turning to the most recent low to see if we break below this low. And when we break below that low, you know you're starting to confirm the potential for a market reversal. Okay, I'm giving you a little lesson in technical analysis and a little lesson in market history here all at the same time. So fast forward a little bit. By January of 2008, we had done that. We dropped below those price points and the market reversal was starting to take shape. Okay. Now you've completed the head and shoulder. There's your left shoulder. There's your head. There's your right shoulder. We've put that in, but still the news media in January 2008 was not screaming recession. They were not screaming it's the end of the financial world as we know it. They were not screaming financial crisis. What were they screaming? It's a buying opportunity. It's a buying opportunity. If you listen to Jim Cramer in January 2008, he's screaming all over CNBC, buy, 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 buy. I'm buying right now. It's all on discount. The exact wrong advice for a market top. Okay, as you fast forward through January and February, that buying sentiment was actually rewarded as people bought in and they started to see the market rally for just a little bit. But now we've just put in the third piece of confirmation. What we now have is we have a lower high followed by a lower low followed by a new lower high. This is a three-point reversal, and once you have a sequence of lower lows and lower highs confirming in a series of three, so you have a lower high, lower low, then a lower high, the next move is the full-blown confirmation of the market reversal, okay? That's exactly what we got. This happened in May of 2008. We still did not have the media admitting or telling anybody that we were in the middle of a financial crisis. Finally, you get into June and people start to freak out as we drop below the next level that we call a support level. It's right around 12,000. And as we start dropping below that level right there, people start recognizing maybe there's something more going on. At that point, ladies and gentlemen, recognize what had happened. The Dow Jones Industrial Average had fallen at that point from 14,400 to 11,200. Just so you have a little bit of math and a little bit of perspective of where you are in this cycle, 14,400 minus 11,200 is 3,200 points. If you divide that by 14,400, you get the percentage, which is 22%. Now, according to the media, a correction happens after 10%. But since the media does a really great job of only looking at January to year to date, what they were calculating at this time was a move from 12,000 down to 11,200, a mere 800 points. If you zoom out and you take a bigger perspective, you realize that by the time the world started realizing we might be in financial trouble, the market had already sold off 22%. This was just the Dow. Okay? Let's continue on this journey. Finally, the big sell-off came in September and into October. We had a little bit of a bounce, and then the final move came into February and March of 2009. By the time we got done with all of this move, the market had corrected all the way down to a bottom of about 6,500 off of the highs of 14,400. It was a brutal market sell-off that most people think that they could not survive. But they did. 14,400 minus, we'll just round it to 6,500, being a little overly conservative there. 7,900 points of selling based on 14,400 point index was a 55% sell-off. Okay, so this is a 55% correction that we had in 2008. 55%. Now, I've got quite a bit that I want to go into in this video, so if you need to pause and come back and skip around a little bit, that's fine. I'm going to draw a lot of parallels between 2008 and where we are right now. The reason I went through this historical situation in 2008 is because of where we are relative to this right now in 2022. So let's come back to present time. Let's rescale. And I want you to notice what's happening. If you listen to the news media says, it's bad, but it's not that bad. The news media looks at January to current, and until this past week, they haven't made a big deal about it. But let me start drawing out some interesting things for you. Number one, do you see a left shoulder, a head, and a right shoulder? Now, not all market tops have head and shoulders, but this particular one does have a left shoulder, a head, and a right shoulder. Okay? Next, what I want you to recognize is that the market peak happened in November it happened the first part of January for the Dow. It was in November for the NASDAQ. Make that distinction. Just make sure we're clear here. For the Dow, it happened first part of January at 36,800. We're currently at 32,160. So let's just run some quick numbers on that. 36.8 minus 32,160. That's 4,640 points on a 36,800 point index. That's 12.6%. That doesn't sound too scary for most people. Okay? What you're not seeing on this picture, just like you didn't see in 2008, was the relationship of the NASDAQ, which is down almost 30%. We're going to look at some more at that here in just a moment as well. Okay? Just recognize where we are in this move. If you look at this move and you parallel it to 2008, the big crash is yet to come. The big selling is yet to come. Okay? We are early in this move. Right now, this week, as the market has been selling off for the last couple of days and the end of last week, we are in that new phase where this thing is selling. And if I were to relate that to 2008, sorry, I just banged the microphone here. If we relate this to 2008, let me show you where we are in that cycle. Forgive me, it's just not as easy as pushing a button and being there. Once it was, now it's not. If we were to look at where we were in 2008, the relationship to that is, ironically, May. May of 2008, you are here. If you make this connection between 2008 and now. Okay? So 2008, May was the head and shoulders, left shoulder, head, right shoulder, first sell-off, rally, and the second wave of, or the next major wave of the selling. That's where we were then. Guess where we are right now? The exact same spot. Let's reset the chart maybe. Are you going to reset for me? Maybe not. Sorry about this. Well, it's going to go on exactly the pace that it wants to go. I don't know why it's not resetting, but let's try this button here. There we go. There we go. If you look at where we are right now, left shoulder, head, right shoulder, sell off, rally, boom. You are here. You saw in 2008 what happened. I'm not saying that's exactly what's going to happen next, but I am going to say that because we're about to see all of that stuff as it starts to come into fruition. What we're in the middle of is we're in the middle of a market reversal, folks. And I'm not saying this to scare you because there's plenty of opportunity. We are actually very, very early in this market reversal. Actually, we're about to get into the exciting part, the part that starts to look a little bit more scary. I expect the next moves for the Dow. Let me just lay that out for you, and then we'll talk about some of the other stuff. I'm going to put my lines back on here. Right now, we are at what we call a pivot area. That's my yellow line that you see in here. This is the price point that we had targeted to see what would happen when we get here. So we are there. That's the reason I'm doing this video, because we are here. So the questions are, where do we go next? And I'm going to give you the layout of the possibilities of where we go next. I do believe, I'm going to give you 3 forecasts. I do believe the most probable forecast is that we are going to pound into this support level, have a little bit of a rally to one of these turning points, and then sell. And we will label that 1. That is my primary forecast right there. I don't think that the big crash is going to happen this week. I may be completely wrong. That's going to be one of my other forecasts. But I think what we're going to see, and we started to see it today, we're going to see this support building right around 32,200 on the Dow. We're going to see this support building. It'll probably go sideways for a little bit, bounce just a little bit, again, suck in some buyers into what we refer to in a bear market as a slope of hope, as people keep buying when the market's falling, and then it will continue to fall from there. My second forecast was that we would do the same thing, but we would not have the rally, and we would just start the next fall. That's forecast number 2. And my third likelihood is the one that Sunday night I said this is my third likelihood. It may become the new likelihood. We'll see. Right there, that we just start falling. Okay. Regardless, one of these 3 is the future. The question is just the timing. And that's always the question. The question is always the timing. But this market structure is pretty well in shape. The one that I didn't draw out is the one that I see almost zero chance of happening, and that is that we would rally from here and keep going. And I put that at like a less than a 1% chance, but it could happen. Now the question is, what happens when we drop below this yellow line? Where do we go from there? This is really the future. This is the forecasting part that you need to be aware of. I've given you kind of the turning point. We're at the turning point right now. We'll see exactly how those turns shape up. Most likely our next target is going to be around the 30,000 range. But the big one that I've really got my eyes on is around 29,000, somewhere between 29 and 30,000. And if I push the right key commands, I might actually get this line to do what I want it to do. Sorry about that. That's going to be right around here. This is where I anticipate we will fall to next. There's a possibility that we could fall to the next trading range below that, which would put us around 26,000 and change, 26,400 or so. Here's what the structure is going to look like. When it finally drops, whether that's forecast 1, 2, or 3, it doesn't really matter. When it finally drops, it's probably going to trade to around 29,000, maybe 30, but probably around 29,000, and then bounce back to the bottom of the yellow line. That's forecast number 1. Forecast number 2, after we drop below this support level, forecast number 2 is that we would drop here, get a lot of chaos, and then just keep going. And if the bear market is very radical, that's how it will be. Forecast number 3 is that it just drops and never comes back, and the chances of that happening are very, very low. I'll go ahead and draw that in here. But a lot of people are looking for this. And that is it's like about a 2% chance. Because that's not how markets correct. The way markets correct are the way that I've drawn it out. We move from pivot area, we move from turning point to turning point, and we bounce. And then we build support, we rally, the selling resumes, we go to the next turning point, we bounce, we rally, selling resumes. And what you're going to find is somewhere probably in late summer. We'll probably we've already started to see it here in May. There's an old saying in Wall Street, sell in May and go away, because the most bearish months of the year tend to happen between May and October. What you're probably going to see, the big question is really, how does it play out from where we are right now? Do we hang out, bounce a little bit, spend most of the summer, and then drop down? That would put us, based on how I just drew that would put us in October to November, the end of the year. Or do we sell off big now and then have more selling October, November? One of those is probably how it happens. You need to have in your forecast here that somewhere between August, September, and October, you will probably have a very bearish market. Probably in June and July, it will be a very stagnant market, maybe with a little bit of a bullish bent to it, but it'll be a very false bullish perspective. And the unknown is exactly how May will set us up for that. May will either set us up with a lot of stagnation, with a little bounce into June and July, or it will set us up with this sharp bearish move that we're seeing right now, with a little bounce in June and July. So June and July will probably have a little bit of stagnation bounce. And then August, September, October, we'll see somewhere in there the resumption of the selling. The question right now is how fast we continue to sell for where we are. Now, we're very oversold on the market right now. Let me bring that up for you. And of course, I've only talked about the Dow Jones at this point. I haven't even talked about the other indices. But if you look at where we are, according to our stochastics oscillator, we're already oversold. We're very oversold. We can get there and stay there for a little while. But typically speaking, I'll make this full screen for you. Typically speaking, once we get down there, we bounce and we go sideways just a little bit. So that's one of the reasons that my short-term forecast is that we're going to start to build the support here. Plus, it's been a very solid support. It takes a lot of work to drop below those major supports. Now, what we've seen in the market in the last week is we've seen a lot of panic. And one of the themes that I've been telling all of my Trade Maestro people is be prepared for an incredible amount of volatility. We've been talking about this since November of last fall, and especially in February this year, and moving forward, it's going to get even more intense. So we saw that last week. We saw 900 points to the upside, followed by 1,000 points to the downside. We saw a resumption of that on Monday of this week, and you're going to see more of that as we move forward. What you have to understand about market reversals, they don't go straight down. Well, let me say that different. Bear markets, they don't go straight down. Market reversals do what we've just been through. I think we're on the backside of the reversal. I think the full-blown bear trend is here in the next 1 to 4 weeks. We'll see the full-blown bear trend really taking shape. What you're going to see in the middle, the day-to-day, when people get all zeroed in and very narrow with their view, what you're going to see is you're going to see big volatility to the downside followed by big volatility to the upside. You'll probably see a VIX reading up in the 80s and 90s at some point. And all that is just telling us how much volatility there is in the market. Now, let's talk about the long-term view on the Dow here, and then I'm going to move over to the other indices and tell you what else is happening that you may not be aware of. I just want to give you my final forecast for the Dow. I think when this is all said and done, and we're looking at probably the rest of 2022 into 2023, when this is all said and done, my minimum target is 18,000. And my maximum target is around 12,000. Now, we might adjust that when we get closer to it, but 18,000 is probably the bottom that we will get to as a minimum. So what you'll see, I'll just kind of draw this out for you. It'll look something like this. And that'll probably be into about halfway into 2023, maybe the beginning of 2024, and we'll start to see the market stabilize. And we will have flushed everything out. Now you say, I thought we were going to have a market crash. I thought it was going to go to zero. No, that's not how the market works. A 50% sell-off is definitely a market crash. This will be known as a market crash, wherever it lands, whether it lands at 24,000 or 18,000 or 12,000 or 10,000. It's going to be known as a market crash. And it's already crashing. So you need to understand that as well. But don't expect this thing to go to zero. That's not what's going to happen. I guarantee that's not what's going to happen. So what you need to understand in this perspective, let's just go to 18,000. Let's assume that's where we land. Let's say we stop at 18,000, okay? We started at 36,800. What's the difference there, folks? You ready for this? Get our old trusty calculator out. 36,800. minus 18,000. You ready for this? It's 18,800 divided by 36,800. 51%. When we get to 18,000, that's a 51% correction. If we get to the 12,000, 13,000 range, going from 36,800 down to 12,000, it's 24,800 coming off the top. Divided by 36,800. That would be a 67% correction of the total market value. 18,000, for reasons I'm not going to get into right now, but 18,000 has the best numbers associated to it. 18,000 has the best Fibonacci's connected to it. There's lots of reason 18,000 is the ideal number, but 12,000-ish could be how far we fall. That's a 51% to a 67% correction of the market. If that's not a crash, then I'm not sure what you're looking for, because that is a crash by everybody's definition. And 2022 will become known as the year of the 2022 financial crisis. I'm pretty certain of that. So that's how the Dow Jones shapes out. But let me take you to some other pictures here that maybe we haven't looked at yet. Maybe you didn't realize. People keep asking me, they keep saying, Jeremy, when's the crash going to happen? When's the big one going to happen? And I keep telling them it is happening, and it's happening now. Let me show you some charts. Let's take, for example, Zoom. How many of you realize what has happened with Zoom? After the coronavirus, Zoom went from, in early 2020, less than $100 a share, about $80 or $90 a share, and we peaked out at $573 a share. $573 is green line up here, okay? You can see all the bearish trades we've had on the way down, and we are currently trading at $90.68 on Zoom, okay? This is Zoom. We went from 573 down to 90.68. That's our closing price today. If you run some math on that, 573 minus 90, we'll just call it 91, make it easy. $482 divided by 573. How much do you think that is, folks? 84%. Don't tell me Zoom hasn't crashed already. Zoom has already crashed. It's down 84%. I don't think Zoom's going to drop a lot lower than 62.40. That's our target on this. We've had several bearish trades on the way down. You can see some of those on the chart. 62.40, just call it $62, is my next target for Zoom. Let's take a look at Netflix, folks. Netflix. People keep saying, when's the crash going to happen, Jeremy? Well, it was only November of last year. We're less than 6 months ago. Netflix was trading for almost $700 a share. Today, it's at $177 a share. So let's just do some math on that. 700 minus 177. That's $523 divided by 700. I know these are round numbers. That's a 74% correction. How much more do you want? By the way, we've been in a whole bunch of these bearish trades. We forecast the first wave of it. We forecast the second wave. We forecast the third wave. We're currently in the middle of the forecast for the fourth wave. And I'll tell you where we think that Netflix can ultimately end, not much lower than 88.85. We're in the middle of the third wave. This trade just triggered in the last couple of days for us as a bearish trade on Netflix. We're already down 75% though. I mean, for those of you who think the market's not crashing, the market is crashing. How many of you are aware of the FANG stocks? So FANG stocks are Facebook, Apple, Amazon, Netflix, and Google. And some people have started to include NVIDIA in that. So it's FAANNG, FANG with two N's. So let's just go through those really fast. Facebook. These have been the bellwether stocks. You know, people keep thinking Facebook is the place to stick your money. We've been bearish on Facebook since we were at 325. That was our first big bearish entry. Some of you have seen me do forecasts and you've heard me say, well, if you'd only gotten out up here, if you'd only gotten in, well, we did. We got in bearish at 325. Facebook today is at 197, but it peaked out up here at almost 380. Okay, we're currently set up for our next major bearish move, which puts us down here at the target of about 154 on Facebook. Okay, so starting with 380, assuming that was our starting point, just talking about how much market data we've lost on this, 380 minus, what's our current? 197, we'll call it, round it up there. It's 183 points on $380, 48%. Facebook is already down 48%. Don't tell me the market's not crashing. This is one of the bellwether stocks. Apple. Apple's holding in relatively strong. Our peak on Apple was around $180. We're currently at $154, so we're only down $30 on that. Relatively speaking, that's not too bad. Okay, let's look at Amazon. Looking at Amazon here. Amazon peaked out up here at $3,700 and almost $3,800. We'll round it up to $3,800. We are currently at $2,177. Let's just put some quick numbers in there. Round numbers, 3,800 minus 2,180. 1620 divided by 3,800. That is a loss of 42%. Don't tell me the market's not crashing. By the way, that's a pretty steep move that we've seen in the last month or so with Amazon. We also had this one set up with a bearish entry at 3,026. We've hit all of our targets and we've exceeded that. And we'll be doing some target updates for that. The next target's going to be, next major target is going to be the $2,000 range and then roughly the $1,750 range. But moving on here, Netflix. We've already looked at Netflix. Let's look at NVIDIA, company that I really like. We like their products. We've been in 3 bearish trades on NVIDIA. The first high, the ultimate high was around 340. We're currently at 175. Let's do some quick math on that. 340 minus 175. It's a $165 loss on 340 original price. It's a 48% correction already. Next target on NVIDIA is 155. Okay, that's a trade we're in as well. What am I missing? FAANG, Google. The old Google Meister. Google peaked out last November at a little over $3,000. It's currently at just under $2,300. So if we just use some round numbers on Google, 3,000 minus 2,300 would be a 700-point loss on a 3,000 original price. There's a 23% correction. So Google's only down 23% since November. Those are the FANG stocks, folks. All of the FANG stocks are down substantially. More than half of them look like they're crashing. Zoom. We've looked at Zoom. It's down 84%. How about Moderna? Company that's been manufacturing a lot of the vaccines. We started some Moderna trades. We moved it, but our first one was up here at 332. The peak for Moderna was almost $500 a share in August of last year. In November, it was about 460. Current price for Moderna is 132. We're in that bearish trade as well. We've hit every one of our targets on Moderna. But when you do the math on that, let's just do 480 as a peak, which is a little conservative. 480 minus current price of 132. That's a $348 sell-off. 480 being the high. It's a 72% correction on Moderna. I think you guys are starting to get the idea of what I'm trying to tell you. The market is crashing. The market has been crashing. The market is going to continue to sell off. But what people keep looking for, and really, unfortunately, they're prognosticating in a very bearish, negative way. They're putting a very negative energy out there. People are trying to ask, when's the whole thing going to collapse? Look, it's not going to collapse that way. We're seeing the collapse right now. In fact, what we're seeing is some of these major positions. These were stocks that have a lot of market cap that are down 75, 80%, 50%. Lots and lots of these stocks are already down that much. And then you look at the indices, you say, well, why are the indices not down that much? Well, the Dow Jones, understand the Dow Jones is only the Dow 30. It's only 30 stocks. You look at the S&P, it's down more than the Dow. It's got 500. You look at the NASDAQ. NASDAQ is tech heavy. Some of these stocks like Apple and Amazon, they're in the NASDAQ. So that's why the NASDAQ's down almost 30%. You look at the Russell, it's down 26%. But you look at these individual trades and you realize that a lot of these companies have already basically collapsed. And there's a lot more that are on the way. So what we're watching for and what you're going to see over the next several months here is you're just going to see a lot more of these companies that have been hanging on. You're going to see some of those guys losing value. A lot of these are hitting their bottoms. You're going to start seeing buying opportunities in a lot of these companies. A lot of people think, well, I think the company is just going to collapse. It's going to disappear. No, that's not what's going to happen. You're going to start to see with a lot of these companies, and I know a lot of you are worried about corruption and stuff. What you're going to see is you're going to see the filtering of the bad stuff getting out. You know, a lot of the social media companies in particular, we started to see it like with Twitter, for example. Like that whole move with Elon Musk taking over Twitter, and I'm not speaking necessarily to his intentions being pure or impure, but a lot of that stuff that we're seeing is actually a filtering out of some of the corruption. And we're getting some of these companies are going to go private. Some of them will just get the corruption filtered out. We'll get the base put in, and then you're going to start to see some changes taking shape. So we've been talking in our Calm in the Storm Summit over the last few nights about the fourth turning and some of these transitions and old institutions dying and new institutions coming. A lot of people think the stock market is going to disappear. It's not. It's just going to get cleaned up, and then it's going to be a more pure market moving forward. So I hope this has been helpful for you. I've got a lot more I could go into. I could also go into how if we were to denominate the Dow Jones average in gold relative to where we were in 2008, or actually we never left the 2008 crisis. The only reason that you see these higher prices is because of inflation. I could go into those numbers. I could talk about the economy and the depression that we're in. It's an inflationary depression. We've been in it since 2008, but I don't think it really is going to help anything. I think what's going to help you guys right now is just kind of have a perspective of where we are in the market, what's going on. Those of you who've been saying, when's it going to crash? It is crashing. We're already in the middle of it. It's been crashing under your nose. If you've been, hanging on, some of you have been losing money and you're saying, why am I losing money? Well, get out, learn to trade, learn to recognize real trading opportunities. I mean, I've shared with you a lot of the bearish trades that we've been in at Trade Maestro with some of our Sunday night stuff that we do. As soon as we get to the bottom of this, we're going to see several weeks and months of bottoming, and then we'll have some of the best buying opportunities of our lifetime. So it's coming. I promise it's coming. If you want to learn to trade the downside, then come to Trade Maestro and let me help you learn how to do that. If you want to sit it out, then I recommend actually at this point, when in doubt, go to cash. And I know some of you say, well, I don't like cash. Cash is being inflated and it's not worth anything anymore. Look, would you rather have all of an inflated cash, or would you rather have none of an inflated cash? If you keep your money in the stocks while the market's crashing, you're going to have none of inflated cash. So it would be better to just have your positions in cash and hold that through the bear market. And then when we start crossing back over moving averages, we get back into the bullish trends, then you go back in, you buy your new positions of whatever it is that you want to get into. That would be a better way to approach the market than it would be to just hold all the way down and then you have to hold all the way back up and you just go through the roller coaster. That's just emotional damage that you don't need to take on. A lot of people are saying, well, what about bonds? Well, bonds are probably, in my opinion, this is very much my opinion here, but bonds are probably not a great place to go because inevitably, if you look at economic cycles, what happens at the top of economic cycles, one of the key bellwether things that always happens is central banks raise interest rates. Well, guess what that does to bonds? It ends up making bond prices go down. So, while bonds are good in a recession, when the market's going down, they can be an offset of risk. In this particular scenario, it may not be a good solution. Cash may be as best a place as you can go. What about getting into gold and silver? And I do want to talk about this briefly. Silver right now is actually at some major bottoms. I do not think it's going to stay here forever. It could head on down to $17. This is the silver ETF, by the way, SLV. But we're very oversold on this. It's been putting in a bottom. I think we're probably going to see that pretty quick. I was surprised to see it sell off as much as it did today. Oh, you're not seeing my chart. Let me share this with you. There we go. Silver, as you can see here, is at a bottom. I think it's probably going to bounce, but we'll have to find out. We don't have the signals for that yet. If it does continue falling, your next target is about $17. Again, this is SLV, the ETF, the Exchange Traded Fund. That's what that is. Gold is putting in a bottom, I hadn't looked at this update today. It was putting in some support at a previous resistance. It's dropped below that. So our next target for that is to pick up this trend line right around 170 on the GLD ETF. That translates to about 1,700 on the gold spot price roughly. Gold and silver are actually falling as well. We're going to be sharing an opportunity tomorrow night. If you're around, we're going to be sharing an opportunity in our Calm in the Storm Summit for how you can actually denominate your banking in gold and silver. And you can actually get a debit card right now. You don't have to wait for anything new. You can do this right now. You can get a debit card and actually start spending against your gold and silver. So that is a solution potentially for some of you as we see the market crashing. But, I always say there's no harm in being in cash. If you don't know what to do, just go to cash, wait it out, ride out the storm in the cash. It will eventually hit a bottom, and then we'll go somewhere from there. While I know I'm kind of bouncing around, I have a bunch of open loops in my mind right now. I want to address an issue that I saw on social media tonight. And, like a lot of rumors on social media, they spread really, really fast. And gold and silver probably gets as many rumors as anything. So the rumor that I saw, and I'm going to probably make this number slightly up. It was something about Bank of America being in a short position for, I think it was 600 or 700 million ounces of silver. And I'm not sure where this started, but I've seen it on several feeds today. And what people are saying is because Bank of America is short all this silver, they're going to get stuck and they're going to have to cover all their short positions. And it's going to cause the price of silver to go up to $500 or $600 an ounce. It's not the way it's going to happen. Let me explain it to you. That would essentially be a short squeeze. It's kind of what happened with AMC and the other stock that I've forgotten happened last year. GameStop. That was the one I was trying to think of. So with a short squeeze, basically what happens is institutions start shorting a position and then holders come in, buy the position, and they don't release the funds. They don't release those positions for the short sellers to cover their position. That's what happens with a short squeeze, and the price ends up going up. While I haven't looked at all the data, it's probably not how Bank of America has done it. So I'm just going to dispel the rumor right now and tell you probably what's happened because I know how most institutions work. Bank of America is an institution. It's not a hedge fund. Hedge funds will go do those short trades and have no way to cover their risk. An institution is not typically going to do that. What an institution will do is they will use other derivatives to offset their risk. So if you go look at the open interest on June call options, for example, for SLV, there's over 20,000 open interest for calls, and they can buy that for about 20 cents. What does that mean? That means that those short positions can be hedged. And so what that does, 20,000 calls is approximately 2 million ounces of silver. They're going to spread that hedge out, build out what's called a ladder, and they'll spread that risk all the way across. They'll spread it over time. They'll spread it over price points. So while the price of the silver might start to go up, these institutions are already hedged. They've already planned for that. They've already planned for the risk. And so even though they may be in short positions, and I haven't looked if they're short futures positions or actual spot positions, I'm not sure where they are, but even though they've taken some short positions to trade the downside of silver and gold, they've hedged themselves to some extent. So this idea that these positions are going to take down the institution, it's not going to happen like that. I'll be absolutely stunned if they did that. Like, one person would say, oh, well, that's what's going to happen. Everybody's going to be stunned. No, that's just not how they manage risk. Institutions manage risk a lot more reasonably than that. In addition to that, the other thing you need to understand, short positions on paper do not mean short physical positions. Short positions, institutions will take short positions on paper, like for example, in futures, and they never expect to take delivery of that. 98% of all futures contracts expire without delivery. So they're paper positions, and that's all it is. You don't have to have the physical commodity to offset the short position. And a lot of people right now, some of the stuff I've been seeing this afternoon on social media, people are saying, well, there's not enough silver to cover it, and so they're going to get stuck in a short squeeze. No, they're not, because they're paper positions and they've offset their risk with other paper positions. I promise you, the likelihood that Bank of America has put themselves in a situation with short silver that it could take down the entire Bank of America operation and institution, the likelihood of that is almost zero. They just don't manage risk that way. So just because you see the story, don't buy into it, don't believe it. I know this is a total tangent from where the market's at and what's going on there, but it's a big hot story that's going on right now. And I just want to kind of, get you guys off your horse and don't read into all the hype. That's probably not what's going to take down the banking system. It'll be something else, or maybe not. Maybe it's just, maybe the banking system isn't falling apart. Sometimes people just expect that everything's going to fall apart, and that's an overreaction. So, all right, I have talked in circles. I've gone on long enough. I'm not even sure how long I've been talking now, but I hope this has been helpful for you. Hope you've got some good information out of this. And look, folks, be encouraged. There's a lot of great stuff happening in the world right now. There's a lot of great opportunities. If you've not joined us for the Calm and Storm Summit, please do so. I don't have anything to stick on the screen, but go to calmandstormsummit.com. And we got one more night of that for Wednesday night. You're welcome to join us for that. If you've not checked out what we're doing over at Trade Maestro, please do so. If you've not subscribed, then by all means, please get yourself subscribed to wherever you are. If you're on Telegram, subscribe to our channel, or if you're on YouTube or If you're on our website, subscribe to our mailing list, wherever, just so you can get updated and get all the stuff. And look, folks, be encouraged. There's great things happening. Great opportunities are coming. You might have to wait for a little bit before the prices get to the price that you want, but there's great stuff happening, and be encouraged. The future is bright. All right. Thanks for joining me. I look forward to talking to you next time. And until then, happy trading. Talk to you soon.